Disney is one of those stocks where the brand can make the analysis feel easier than it actually is. Everybody knows the characters, the parks, ESPN, and Disney Plus. But the stock question is different. Are you getting that engine at a price that makes sense? My answer is more positive than a simple watchlist call. Around $102, Disney is close enough to my fair value range that I'm comfortable calling it a buy in FinanceToGo terms. But it is not a strong buy territory for me, because the margin of safety is not huge and the business still has a few areas that need proof. Three numbers that decide Disney. So there are three numbers I would keep coming back to with Disney. Adjusted EPS, free cash flow, and domestic parks attendance. If earnings grow, cash flow stays strong, and the parks stabilize, the buy rating gets easier to defend. If one or two of those start moving the wrong way, the setup becomes much less clean. This is not financial advice, I'm walking through the numbers so you can decide whether Disney belongs on your own research list. And if you like stock breakdowns that separate famous brands from actually attractive prices, subscribe to FinanceToGo and let me know which ticker you want next. So what business are we actually buying? Disney is not just a movie studio, and it's not just a theme park company either. The real attraction is the flywheel. A character can start in a film, move into streaming, become part of park attraction, show up in merchandise, and stay relevant for years. That is the quality side of the stock. The messy side is that the pieces have different risks. Parks are powerful but tied to consumer spending. ESPN is valuable but sports rights are expensive. Streaming is improving but competition is not going away. So this is an iconic media and experiences turnaround, not a perfectly clean compounder. Did the latest quarter prove enough? Fiscal Q2 gives us a mixed but useful picture. Revenue was $25.2 billion, up 7%. Adjusted EPS was $1.57, up 8%. Free cash flow was about $4.94 billion, up slightly. Those are the green flags, because they show the profit and cash flow story is not just theoretical. The caution is on the other side of the board. Domestic parks attendance was down 1%, sports operating income was down 5%, and GAAP EPS fell. I don't think that ruins Disney's thesis, but it does explain why I would not jump straight to strong buy. The numbers support a buy, but they still need follow through. My FinanceToGo score is 6.7 out of 10. The best parts are cash flow, brand quality, and the improved earnings outlook. The weaker parts are risk, valuation, and proof. That score fits the conclusion. This is good enough for a buy at a fairish price, but not cheap enough to ignore execution. I like the assets, I like the improving cash flow story, I still want parks, ESPN, and streaming to move in the same direction before treating it like a high conviction bargain. So what is the market already telling us? The chart matters because Disney is not sitting at an obviously distressed price. Around $102, it is in the lower part of my fair value discussion. But it's not dramatically below what I think the business is worth. That is why I would describe this as a fair price buy rather than a table-pounding strong buy. The price is reasonable enough to take seriously. At price below the mid-90s would give the stock a much better margin of safety. Better business proof would also make today's price easier to justify. So, what is Disney worth? My base fair value range is about $100 to $125. The current price is near the low end of that range, which is why I'm comfortable with a buy. But my stronger buy zone is still roughly $90 to $95, because that would give more room for mistakes. In the bear case, if parks stay soft and sports costs keep pressuring profits, I would think more in the $85 to $100 range. In the base case, earnings grow near guidance, free cash flow stays healthy, and streaming economics improve. In the bull case, parks recover, ESPN optionality improves, and buybacks add more per share value. I'm not trying to get the exact number to the penny, I'm trying to see whether the price pays me enough for the risk. So what could make Disney work? The bull case is that Disney's fan relationship is rare. With very few companies can turn stories into movies, parks, cruises, products, games, and streaming engagement. If that engine starts producing steadier earnings and free cash flow, the stock can work from here. Bears may be underestimating the value of that flywheel. Streaming losses have been improving. ESPN still has direct-to-consumer optionality. Experiences can remain a major cash engine, and management is targeting at least $8 billion of buybacks in fiscal 2026. If those pieces line up, today's price could look reasonable in hindsight. So, what could break the thesis? The bear case is not that Disney is a weak brand. The bear case is that great brands still have to beat real-world costs and changing consumer behavior. Sports rights can get more expensive. Linear TV can be shrinking. Streaming can stay competitive. Parks can slower if consumers pull back. Bulls may be underestimating how many moving parts have to improve at the same time. The thesis breaker is simple. If Disney cannot turn strong IP into durable earnings and free cash flow growth, while parks demand and ESPN economics weaken, I would have to rethink the buy label. My verdict is buy, but not strong buy. Disney has iconic assets and an improving earnings story. Also very strong cash flow. At roughly $102, the price is fair enough for a positive rating, but I would want either a better price or cleaner proof before calling it a great bargain. The thesis gets stronger if adjusted EPS keeps growing, free cash flow supports buybacks, parks attendance improves, and ESPN economics move forward. It weakens if park demands keeps slipping, sports costs pressure profits, or cash flow fades after experiences an investment. The reusable lesson is simple. A great brand is not automatically a great stock, but a great brand at a fair price can still be worth buying if the numbers are moving the right way. Is Disney's IP engine enough to offset parks and ESPN risk, or would you wait for a better price? Tell me in the comments. Subscribe to FinanceToGo for more stock breakdowns, and remember, this is educational content only, not financial advice.